Hello, my dear students. We will be continuing with the last portion of the ratio analysis chapter that comes after operating profit ratio. So, we begin with earning per share, EPS, popularly called as. Now, as it is the earnings of a company attributable to the equity shareholders divided by the number of equity shares. Now, very easy, earning per share. Now, we all know that we are investing into shares to expect a certain amount of profit yielded from it. Now, what is that profit called? That profit is called as dividend. It is also popularly called as earning. So, if you can see on page number 4.70, where they've discussed about earning per share, EPS, they've written that preference share dividend is deducted from the net income to arrive at the income available for the equity shares. You've already studied that in one of the theory chapters in commerce, that first preference shareholders, they are being paid the dividend, and then the equity shareholders are paid. Now, this income, when divided by the number of the equity shares, will give you earning per share, right? So, if you check out the formula that has been mentioned in your textbook, it is earning per share, EPS, computed as follows, where it is expressed as net profit after tax and preference dividend. Now, earlier we have come across a term where it was net profit after interest and tax. Over here it is net profit after tax and preference dividend divided by the number of equity shares. Now, logically, if you try and understand that, net profit after tax and preference dividend means what? You've earned a net profit, then you've paid the proportionate tax on that, and then whatever the leftover portion of profit is, you will be paying your preference shareholders, isn't it? So ultimately, whatever is left as residual, that is supposed to be divided amongst the equity shareholders. So we will be taking up that value and dividing it by the total number of equity shares that we've issued in the market, and we'll be getting earning per share. Now, this will definitely help in evaluating the prevailing market price of the shares, and that is how the stock exchange works. That is how we get to know about what are the prices of the shares. So what we do is that whatever the total earning is divided by the total number of shares will give us earning per share. You can see that illustration solved on that very page. Net profit after tax is 50,000, 10% preference share capital 10 rupees each, that's 1 lakh. Equity share capital, again, each share is worth rupees 10, and that is also invested for 1 lakh. So what are we supposed to do? We are supposed to calculate earning per share. Before that, we need to find out, in our working note area, you will be finding what is dividend for the preference shares. 10% of 1 lakh, so that's 10,000. In tax is given 50,000. So your total profit that needs to be calculated would be net profit after tax and preference dividend. So what is net profit after tax and after preference dividend? So over here in the sum, it was given net profit after tax already, so you don't have to deduct the tax once more. It is 50,000 minus 10,000 upon total number of equity shares is 10,000, and the answer is rupees 4 per share. Now, as far as the denominator is concerned, how did you get that 10,000 figure? If you see, total equity share capital is 1 lakh, and per share the value is 10 rupees. You divide 1 lakh by 10 rupees, so you get number of shares, that is 10,000. So obviously rupees 40,000 in the numerator, divided by 10,000, you are left with rupees 4 per share. The next one is price earning ratio, or PE ratio, right? The ratio measures the relationship between the market price share and the earning per share. Now, earning per share is actually whatever the earning per share is, and market price per share means whatever the market valuation of that share is. Now, how will you compute that? Check out the formula. It says price earning per ratio, that is PE ratio, is equals to market value of an equity share by earning per share, by EPS. Now, let's take up the illustration, and I think then we'll go back to the objective and significance. Over here, the example says earning per share is rupees 222. Market price per share is 2,220. Calculate price earning ratio. Now, price earning ratio is market price per share by EPS. So 2,222 by 222. Obviously, the answer will be in times, so it will be 10 times. Now, here if you see, what is market price per share and what is earning per share? That is, see, you've invested in a number of shares, so whatever you've invested, that is market price per share. So whatever money you have actually invested as the market prices of the shares are there, and then earning per share is against your investment, what is the earning per share. So over here, whatever your market market price per share is, you're actually recovering 10 times per share the value of that as per as the example. Now I will go back to the objective and significance of it. The objective of computing this ratio is to find out expectations of this shareholder. So once you study this price earning ratio, so you will be knowing, the relationship between what is the price of the share and how much am I expecting the earning out of it. So it is an important ratio to know whether the shares of the company are undervalued or overvalued, and accordingly you can expect to invest in the market. This ratio helps the shareholders to decide whether shares should be purchased or not to be in a company. And the last one in this chapter is return on investment, which I think to some extent we've done in the goodwill valuation chapter also, where we studied about capital employed, right? So this is somewhat similar, and dragging and continuing with that capital employed concept on the next page. Now when you continue studying return on investment and you lead up to capital employed, the same gist of calculation of ways or approaches of calculating capital employed we've already done in valuation of goodwill, which is on page number 4.72. So you can follow that up, because we've already discussed that under chapter number 2. I'm not going to discuss it anymore, but I would conclude with this return on investment, ROI, popularly called as ROI, that is return on capital employed or return on investment, shows the relationship of profit with capital employed. So how much capital employed, so how much the capital of the company has been employed, and against that what is the profit. The sources means the funds of the business, that is whatever the proprietor has put into, whether his own funds or loan borrowed funds, and the return on that. The ratio is computed by dividing net profit before interest and tax, so PBIT, net profit before interest and tax. And I think when we were calculating operating profit and operating ratio, and we were doing shareholders fund, debt equity, we were doing interest coverage ratio, we were confronting these terms there also. So profit before, net profit before interest and tax by capital employed. Now as the fraction suggests, net profit before interest and tax, and most of the times it will be given to you straight away. If not, if they give you profit after tax, then if you know the rate percentage and the proportionate amount of tax, then you can go for a back calculation, add back the tax and the interest payable, and you can reach up the stage where you have net profit before interest and tax. If it is not directly given, and the denominator being capital employed, like I told you, there are both liabilities approach and assets approach to calculate capital employed, which we have done in detail when we were doing valuation of goodwill into 100%. Now you got to keep this thing in mind, that unlike earning per share, which was expressed in rupees, that is valuation per share, then price earning ratio, which was expressed in times, return on investment is expressed in percentages, so into 100%. What is its objective? ROI is calculated for the overall performance of the enterprise. It measures how efficiently the resources of the business have been used. That's the reason why I said that whatever capital have you invested, what is the return against it? An enterprise should have a satisfactory ratio, so that to assess whether the ratio is satisfactory or not, it should be compared with its own ratios of the past. So you don't have a return on investment contemporary or complementary another ratio. So it's not being joined or to be joined with some other ratio. Return on investment is a standalone ratio on its own terms. So what you can do is to see whether your business has prospered or not, you can actually compare it with the past results and you can find out the answer. The last illustration that I take is return on investment over year in the sum if it's in net profit after interest and tax is 6 lakhs, 10% debentures 10 lakhs, tax 40%, and capital employed 80 lakhs. So over here capital employed is given straight away, and like I told you that if you don't get profit before interest and tax, you got to back calculate and find out. So here the proportionate amount of tax, that is 40%, and interest on long term borrowings, that is 10% on the debentures of 10 lakhs, that is added back, and you get profit before interest and tax, that is coming up to 11 lakhs like specified in the working note. So 11 lakhs by 80 lakhs into 100%, it is 13.75%, right? After this, in the class, to wind up this chapter, there are a couple of illustrations right at the end where mixed and match various ratios have been asked. Now because we've already done those in fragments and segments, we've done all various different types of ratios together, in fact collective ratios also. So we'll be just winding up the class by discussing the last 2 or 3 major mixed and matched problems, and the chapter will be over. Till then, you revise the illustrations and the contents that I've shared with you. Thank you, everyone.